Welcome. Today we're diving into the fascinating world of investor psychology. Have you ever wondered why investors sometimes make irrational decisions, even when all the facts are clear? The truth is, our minds are influenced by a range of emotions, biases, and social pressures that can cloud our judgment. Understanding these psychological factors is crucial for anyone looking to make smarter investment choices. In this video, we'll explore the key concepts, common pitfalls, and practical tips to help you recognize and manage your own investing behavior. Let's begin our journey into the human side of finance. Emotions play a powerful role in investment decisions. Fear and greed are often described as the two dominant emotions that drive market movements. When markets are booming, greed can push investors to take excessive risks, hoping for even greater returns. On the other hand, during downturns, fear can lead to panic selling and missed opportunities. Recognizing how emotions influence your decisions is the first step toward becoming a more rational investor. By staying aware of your emotional state, you can avoid making impulsive choices that may harm your long-term goals. Cognitive biases are mental shortcuts that can lead us astray. These biases affect how we interpret information and make decisions. For example, confirmation bias causes us to seek out information that supports our existing beliefs while ignoring evidence to the contrary. Anchoring bias makes us rely too heavily on the first piece of information we receive. By understanding these biases, investors can work to minimize their impact and make more objective decisions. Being mindful of your thought patterns is essential for successful investing. Herd mentality refers to the tendency of individuals to follow the crowd, especially in uncertain situations. In financial markets, this can lead to bubbles when everyone rushes to buy, or crashes when panic selling takes over. The fear of missing out or FOMO often drives herd behavior. While it can feel reassuring to move with the majority, it's important to remember that the crowd is not always right. Independent thinking and thorough research are key to avoiding the pitfalls of herd mentality. Overconfidence bias is when investors overestimate their knowledge or ability to predict market movements. This can lead to excessive trading, taking on too much risk, or ignoring warning signs. Overconfident investors may believe they can consistently beat the market, but studies show that this is rarely the case. Recognizing overconfidence in yourself can help you make more balanced and realistic decisions, ultimately improving your investment outcome. Loss aversion is the tendency to prefer avoiding losses over acquiring equivalent gains. In other words, the pain of losing money feels stronger than the pleasure of gaining the same amount. This can cause investors to hold on to losing investments for too long, hoping they'll recover, or to sell winners too quickly to lock in gains. Understanding loss aversion can help you make more rational decisions and stick to your investment plan, even when emotions run high. Anchoring effect occurs when investors rely too heavily on a specific piece of information, such as a stock's previous high price when making decisions. This can lead to poor choices like refusing to sell a declining stock because you're anchored to its former value. Being aware of anchoring can help you focus on current realities and future prospects, rather than past benchmarks that may no longer be relevant. Confirmation bias leads investors to seek out information that supports their existing beliefs, while ignoring or dismissing evidence that contradicts them. This can result in poor investment choices, as you may overlook warning signs or fail to consider alternative viewpoints. To combat confirmation bias, make a conscious effort to seek diverse perspectives and challenge your own assumptions before making decisions. Recency bias is the tendency to give more weight to recent events when making decisions. For investors, this can mean overreacting to short-term market movements and ignoring long-term trends. Recency bias can lead to buying high during rallies or selling low during downturns. By focusing on long-term fundamentals and resisting the urge to react to every market swing, you can avoid the pitfalls of recency bias. Availability heuristic is a mental shortcut where people judge the likelihood of events based on how easily examples come to mind. In investing, this can lead to overestimating the probability of dramatic market events like crashes or booms simply because they're memorable. To make better decisions, it's important to rely on data and historical context, rather than vivid but rare examples. Sunk cost fallacy is the tendency to continue investing in a losing position because of the time, money, or effort already spent. This can trap investors in poor investments, hoping to recover losses rather than cutting their losses and moving on. Recognizing the sunk cost fallacy can help you make decisions based on future potential, not past investments. Endowment effect is when people place a higher value on assets they own compared to identical assets they don't own. This can lead investors to hold on to underperforming investments simply because they feel attached. Being aware of the endowment effect can help you evaluate your portfolio more objectively and make better decisions about when to buy or sell. Hill accounting refers to the way people categorize and treat money differently depending on its source or intended use. For example, you might treat a tax refund as extra money and spend it more freely than your regular income. In investing, mental accounting can lead to suboptimal allocation of resources. Understanding this tendency can help you manage your finances more holistically and make better investment decisions. Status quo bias is the preference to keep things the same, even when change could be beneficial. Investors may stick with familiar investments or avoid making changes to their portfolio, missing out on better opportunities. Overcoming status quo bias requires a willingness to review your investments regularly and adapt to changing circumstances. Risk tolerance is an individual's ability and willingness to endure losses in pursuit of higher returns. Understanding your own risk tolerance is essential for building a portfolio that matches your financial goals and emotional comfort. Factors like age, income, investment horizon, and personal temperament all play a role. Assessing your risk tolerance honestly can help you avoid taking on too much or too little risk. Time horizon refers to the length of time you expect to hold an investment before needing the funds. A longer time horizon allows for more aggressive investments, while a shorter horizon calls for caution. Understanding your time horizon helps you choose appropriate assets and avoid panic during short-term volatility. Aligning your investments with your time frame is a key part of successful investing. Clear investment goals provide direction and motivation. Whether you're saving for retirement, a home, or your child's education, having specific targets helps you stay focused and measure progress. Goals also guide your asset allocation and risk management strategies. Regularly reviewing and adjusting your goals ensures they remain relevant as your life circumstances change. Diversification means spreading your investments across different assets to reduce risk. By not putting all your eggs in one basket, you can minimize the impact of any single investment's poor performance. Diversification helps smooth out returns over time and is a fundamental principle of sound investing. It's important to diversify not just across asset classes but also within them. Patience is a key virtue for successful investors. Markets can be volatile in the short term, but history shows that long-term investors are often rewarded. Avoid the temptation to react to every market fluctuation. Instead, stick to your plan and give your investments time to grow. Patience helps you ride out downturns and benefit from compounding returns. Trying to time the market, predicting the best moments to buy or sell, is extremely difficult even for professionals. Mistimed moves can lead to missed opportunities and increased risk. Instead, focus on a disciplined investment strategy such as dollar-cost averaging, which involves investing a fixed amount regularly regardless of market conditions. This approach helps smooth out the effects of volatility. Financial news can influence investor sentiment and market movements. However, headlines are often sensationalized and may not reflect long-term fundamentals. Reacting impulsively to news can lead to poor decisions. It's important to distinguish between noise and meaningful information and to base your investment choices on careful analysis rather than headlines. Social influence, including advice from friends, family, or online communities, can shape investment decisions. While it's natural to seek input from others, it's important to remember that everyone's financial situation and goals are different. Make sure to do your own research and avoid blindly following the crowd. Independent thinking is essential for long-term success. Financial advisors can provide valuable guidance, helping you clarify your goals, assess your risk tolerance, and develop a personalized investment strategy. However, it's important to choose advisors who act in your best interest and to stay informed about your own investments. Working with a trusted advisor can help you avoid common psychological pitfalls and stay on track. Behavioral finance is a field that studies how psychological factors influence financial decisions. It combines insights from psychology and economics to explain why investors often act irrationally. By understanding behavioral finance, you can recognize your own biases and develop strategies to counteract them, leading to better investment outcomes. Self-control is essential for sticking to your investment plan, especially during periods of market volatility. Discipline helps you avoid impulsive decisions driven by emotion or short-term events. Setting clear rules for buying, selling, and rebalancing your portfolio can help you maintain self-control and achieve your long-term goals. Chasing performance means investing in assets that have recently done well. Hopping the trend will continue. This approach often leads to buying high and selling low, which can hurt your returns. Instead, focus on your long-term strategy and avoid being swayed by short-term performance. Rebalancing involves adjusting your portfolio to maintain your desired asset allocation. Over time, some investments may grow faster than others, causing your portfolio to drift from its original mix. Regular rebalancing helps you manage risk and stay aligned with your goals, even as markets change. Every investor makes mistakes, but the key is to learn from them. Reflecting on past decisions can help you identify patterns and avoid repeating errors. Keeping a journal of your investment choices and the reasons behind them can be a valuable tool for growth and improvement. Thorough research is the foundation of sound investing. Before making any investment, take the time to understand the company, asset, or market. Look beyond headlines and hype and focus on fundamentals such as earnings, growth prospects, and competitive advantages. Well-informed decisions are less likely to be swayed by emotion or bias. It's important to have realistic expectations about investment returns. Markets can be unpredictable, and there will be periods of both gains and losses. Setting reasonable goals and understanding the risks involved can help you stay calm during downturns and avoid disappointment. Luck plays a bigger role in investing than many people realize. Even the best researched investments can be affected by unpredictable events. While you can't control luck, you can control your process and discipline. Focusing on what you can influence will help you navigate the uncertainties of investing. Emotional trading happens when decisions are driven by fear, greed, or excitement rather than logic and analysis. This often leads to buying high and selling low. Developing a disciplined approach and sticking to your investment plan can help you avoid the pitfalls of emotional trading. Patience is often rewarded in investing. Markets move in cycles and short-term losses can be followed by long-term gains. By staying patient and focused on your goals, you can avoid making rash decisions that undermine your success. Remember, investing is a marathon, not a sprint. Market volatility refers to the frequency and magnitude of price movements. While volatility can be unsettling, it's a normal part of investing. Understanding that ups and downs are inevitable can help you stay calm and avoid panic selling. Volatility also creates opportunities for disciplined investors. Leverage involves borrowing money to invest, which can amplify both gains and losses. While it can boost returns in favorable markets, it also increases risk and can lead to significant losses. Understanding the risks of leverage is essential before considering it as part of your investment strategy. The illusion of control is the belief that we can influence outcomes that are largely determined by chance. In investing, this can lead to overtrading or taking unnecessary risks. Recognizing the limits of your control can help you focus on what truly matters, your strategy and discipline. Regret is a powerful emotion that can influence future decisions. Investors may avoid taking action for fear of making a mistake, or they may dwell on past losses. Learning to accept that mistakes are part of the process can help you move forward and make better choices in the future. Good investing habits such as regular saving, disciplined research, and periodic portfolio reviews can have a big impact over time. Building positive habits helps you stay consistent and avoid common pitfalls. Small, repeated actions add up to significant results in the long run. Studying the successes and failures of other investors can provide valuable lessons. Biographies, case studies, and interviews offer insights into different strategies and mindsets. By learning from others, you can avoid common mistakes and discover new approaches to investing. The investment world is always evolving. Staying informed about new trends, products, and strategies is essential for long-term success. Continuous education helps you adapt to changes and make better decisions. Make learning a lifelong habit to stay ahead in the investing game. Confidence in your investment strategy comes from knowledge, experience, and preparation. By understanding the psychological factors at play and developing a disciplined approach, you can build the confidence needed to stick with your plan, even during challenging times. Successful investing is about finding balance between risk and reward, emotion and logic, action and patience. By understanding your own psychology and staying mindful of your decisions, you can achieve a healthier relationship with your investments and improve your chances of success. Regularly reviewing your investment progress helps you stay on track and make necessary adjustments. Set aside time to assess your portfolio, reflect on your decisions, and ensure your strategy still aligns with your goals. Ongoing review is a key part of successful investing. Celebrating your investment milestones, no matter how small, can boost motivation and reinforce positive habits. Recognize your achievements, whether it's reaching a savings goal or sticking to your plan during a tough market. Small celebrations keep you engaged and focused on your long-term journey. Understanding investor psychology is a lifelong journey. By recognizing your own biases, managing your emotions, and developing disciplined habits, you can make better investment decisions and achieve your financial goals. Remember, successful investing is as much about mastering your mind as it is about understanding the markets. Stay curious, stay disciplined, and keep learning.